$52 billion in market value. JP Morgan lost $22 billion. Bank of America, $16 billion. Wells Fargo, $10 billion. Citigroup, $4 billion. After the collapse of Silicon Valley Bank on Friday, then Signature Bank on Sunday. Trading was halted on multiple banks on Monday morning. Bank shares were in free fall for a while. First Republic lost nearly 62%. PacWest dropped 45%. Western Alliance 47%. Zions 26%. KeyCorp 27%. Charles Schwab 11%. Bank of America nearly 6%. Trading would be halted multiple times to contain the panic. So what was going on? What were people panicking about? Fear. Fear was the primary driver for pretty much all of this. When you have money, the money comes as printed by the Federal Reserve. It is not a government entity. It is a private entity that is basically owns or I don't know which one owns which. It's all the same money as the 5 or 6 biggest banks in America. So they run the Fed, okay? And they also run the banks, or the banks run them, I'm not sure. But they print the money, they give it to the bank, then they loan it at a certain percentage. It has been 0 for the last, 10 years or so. So they loan it to the banks for 0. They loan it to you for maybe 1% because you're going to start a company or it's going to build new things in your factory. You're going to buy a car or a house or whatever. And you pay 1%, they get the 1%. And when it's deposited, they keep the 1%, supposed to give it back to the Fed. Okay? That's the way it works. Now, when you have a collapse of an economy, and you have what happened in 2008, you're hearing this again, you have a liquidity crisis. People are holding onto their money. There's not enough money in the system. So they print more money. They put it out, hoping that it will stop a collapse. Well, they did this. They called it quantitative easing. I like to call it money printing. Now, they say it's not money printing because it's digitized. Quantitative easing, they put it at a 0 interest rate. They're trying to get you to borrow money because they want you to buy stuff because that makes the factories work and the real estate agents can make money and then they can spend it going to the movies or whatever. So they push all this money out in record numbers. More currency is out than at any time in the history of the world. So we're pushing all this money out. But Silicon Valley Bank was a big beneficiary, as all of the banks were, of this. Now, 2018, before the pandemic, Silicon Valley Bank had $49 billion in deposits. By 2021, they had $190 billion. Business was good. Scale. Okay, so what do you do? Bank is the same as you. When you have lots of extra cash, what do? Well, you might put some in a savings. You might put it in your checking account. But you don't put a lot of it in the checking account. And you try to stay away from savings if they're not paying you anything. You also might buy some stuff that you really don't need. Then you'll buy a house or car, real estate. If you want to be smart, you'll invest it in the stock market. Or if you want to be safe, you'd put it in gold or silver. If you want the safest place money could ever go to, you fall down in front of the altar of the almighty government. I have full faith and trust in the federal government. That's what they tell you. Okay, safer than gold or silver. That's why they have inverse treasuries. So what did they do? Silicon Valley Bank, while you went and bought stuff, real estate, cars, whatever, if you could afford it, put some in your savings, they took their money, some of your savings and everything else, and they bought treasury bills. Now, this one is a little strange. They bought treasury bills. Everybody was making money. Everything was going well until it wasn't. The reason why this is strange is they bought 10-year treasury bills, and they bought it in the good times. So we all felt good. Oh, man, that's great. Yet we all also realized you can't do this. You can't print massive amounts of cash, as the Fed always does, because you'll get inflation. We couldn't afford to put gas in our cars, buy groceries. The cost of a used car was insane. The operating costs of the tech companies and startups that use Silicon Valley Bank, likewise, all that shot through the roof. The bank's balance began to tumble because the companies in Silicon Valley were not cutting any of their expenses. They were spending like they were in the good times. So they were pulling money out of the bank. You couldn't afford it, so you were pulling money out of the bank. Other banks started offering you better interest for your savings, so you pulled out of this bank and maybe went to another bank. So the Fed went into their usual autopilot mode because what is inflation? Inflation is too many dollars. They've done that. Chasing too few products. They inflate. If they've inflated, they raise interest rates. Then, when you go to get a loan, you're paying the bank. The bank is maybe charging you 8%. The Fed is charging the bank maybe 5%. Okay? So they keep their profit. You bled dry, and they get 5%. And what do they do with the 5% of cash that comes back? They're supposed to put it in the crematorium and burn it. That way they get rid of too many dollars. But the problem with this theory is you're not only destroying the dollars, if you raise the interest rates too high, then you can't buy anything, which means factories have to lay people off. The factories can't build. The jobs start to go away. So it's a really delicate math problem. So, Treasury bonds. They had all these Treasury bonds at Silicon Valley Bank, whatever. But they bought 10-year bills, which means if you're going to invest and you're going to have that money for a while, go ahead, put it in a 10-year investment. However, when you buy them at the good time, the zero interest rate applies to you. They bought bills that were almost at zero. So you're not getting any profit. The price of a T-bill, what you get in exchange, if the interest rate goes up, the interest rate goes up on these. But not if you already have them. But if I buy a 10-year bill today, I'm going to get, instead of zero, I'll get 5%. So why would I buy one at 0% today? By November of last year, JP Morgan addressed the elephant in the room. They warned that on top of Silicon Valley Bank's cash problem, they also had $16 billion in unrealized losses. Unrealized loss. For you, it's maybe your house. If you didn't sell your house when it was at a high, did you lose any money? You only lose money if you have a for sale sign in there and you have to sell it today. Then you have a realized loss. An unrealized loss means, my house isn't worth as much today, but I don't have to sell it, so I'm not going to lose anything. Panic is the problem. If you have to sell your house, then that unrealized loss becomes a realized loss. Well, Silicon Valley, they had an unrealized loss, but because they had people pulling all their money out, they had to have money, so they started selling their bonds. And again, why would I buy a bond from them when I can get 5%? So if you're panicked, I guess, I'll make a deal, but you're going to lose 20 cents, 25 cents on the dollar. Now, Joe Biden says everything is fine.
We feel confident because I'm in charge of having my children moving right.
I know, he filled me with confidence. He says that the FDIC is going to ensure that everyone gets their money, and it's not going to cost you a dime. Everybody? I read the sticker on the door, up to $250,000. That's why if I had money like the people at Silicon Valley do, I'd put it in multiple banks. But you just changed the law through executive order? Wow. The FDIC, it is something that every bank pays into, a certain amount, and everybody pays into it in case your bank collapses, then they have the cash. They are flush with cash. They only have $128 billion in cash. So, just for the two banks that have collapsed so far, Those two banks need $264 billion. So half of them will get their money unless